Welcome to another video from Creativo Solutions. You're currently watching the Accounting for Non-Accountants video series. I hope the video series is being helpful to you in terms of understanding the accounting language. We've spoken a lot about the language of accounting recently, and we learned about the rules. Please post comments and questions below. Let me know if this video series is helping you. What do you want me to post more videos about? Let me know by posting a comment. Please also subscribe to the channel and visit the website for more content and resources to help you. Remember, we spoke about the financial position. The financial position comprises of an asset and a liability. We've got those two sides to the financial position, and we know that the net is obviously going to be the owner's equity. So we saw the accounting equation in a previous video. If you haven't watched that video yet, please go back and revise. Owner's equity can be calculated from our assets and our liabilities. If I take the difference being the net amount, so i.e. assets minus liabilities, gives me the owner's equity. So if I'm looking at the definition of a liability, why are definitions important? Well, in a previous video, we explained that accounting is a language for doing business. It's a language for communicating financial information. So if we don't understand the language, we're not going to be able to interact and do business. So the definitions are key because we'll see lots of different accounts, and those accounts need to be grouped under a specific element. The element that we have here is called a liability. There are 6 elements in total. So far we've looked at an asset, and now we're looking at a liability. So what is a liability? Well, the definition is a present obligation of the entity arising from a past event. Okay, that's what we're looking at. So we look at the keyword obligation. An obligation is something that will give rise, to an outflow of benefit in the future. Obviously, there needs to be a past event that must have occurred to create this obligation. Do we like liabilities? Well, if you look at the definition, no one wants to have lots and lots of obligations that will give rise to future economic outflow in terms of benefit. If there's a future outflow of economic benefit, the business is not going to earn more in terms of value, it's going to lose value. Right, so we want to earn as much as we can in terms of value for our shareholders, and we want to generate good return on investment. And the only way we can do that is by limiting our liabilities to maximize our assets. We're not going to cover too much of the finance in this particular module. That's more the decision making around the actual funding of different projects and purchases of assets. In this particular video, we're just going to focus on the accounting. We're going to focus on the definition of a liability, and we're going to talk about some examples and how do we approach a liability from an accounting point of view. The question we have here is, why is it important in terms of the definition? Okay, we need to think about this very carefully because we know that communication is important for our users. So users need to be able to understand what we're presenting to them in the actual financial statement. And that's why it's important. It's important because it creates a basis where we've got a standard way of recognizing certain accounts. We can't incorrectly classify accounts as being assets when they're actually liabilities. That would be fraudulent. Okay, we have to be truthful and honest to our users. So I cannot take a liability which we know is an obligation and we can't classify that obligation as an asset. That wouldn't be correct to our users. And that's why we need disclosure. And disclosure is that communication that we need to present to our users, the owners of that particular business or the investors. Here we have some examples of different liabilities. You probably see them every day. People talk about mortgages, people talk about business loans, people talk about short-term or long-term loans. And the key word that's always mentioned at some point in time, when credit becomes bad, people often refer to it as being debt. No one wants to be in debt. If you've got a lot of bad debt, that's going to be a very bad position to be in. So when looking at a liability, all of these are different obligations. A business loan is an obligation to pay the financier or the bank or the loan institution a specific amount in the future. with interest. So we know liabilities are obviously going to attract interest. So a business loan is definitely an obligation because it arose from the actual event. I had to fill out an application to take out the loan. Once the loan was taken out, now I'm going to have to pay back in the future, and that leads to the outflow of economic benefit. The same with the mortgage. We're just looking at the mortgage on its own. Yes, we know mortgages are used for financing the purchase of a house, okay, which we know is an asset from the previous video. But in this video, we're focusing on the one side of the account being the mortgage, being the liability. Remember, there's a double entry rule. Every debit must have a credit. So there'll always be two sides to every transaction. In this video, we're focusing on the liability. So if I'm looking at a mortgage is an obligation because I have to pay back the actual capital that I've loaned from the bank with interest. And that's a mortgage. It meets the definition of a liability. Why? Because for the person taking out the mortgage, they're going to have to pay something in the future, which is an outflow of benefit from the present obligation, having taken out the loan. Now we have a slide here looking at perspective. Perspective is very important, especially when we are looking at accounting. Okay, we know debt is a bad word and credit is a good word. So when looking at debtors and creditors, we know now that a debtor would be someone who has bought goods on credit from the business. So from the business's point of view, a debtor is someone who owes the business. And that's great. Why? Because it's a resource you control that will give rise to future inflow of economic benefits. So if I have an asset in the form of a loan that I've given to someone, that person who I've given the loan to is going to ultimately have to pay the business back. So a little bit of revision there from our previous video looking at assets. Hope you remembered all of that. If not, go back and watch the video. It's detailed and it tells you the definition of an asset. What about creditors? Well, again, from the business's point of view, does the business want to owe lots of suppliers? Well, the answer would be no, purely from an accounting sense. Okay, we're not going to be looking at cash flow and the benefits of taking out credit on certain transactions. So that's not a finance presentation that we're looking at here. We're focusing purely on the accounting. So if a business is owing suppliers for having purchased on credit, those suppliers would be considered creditors of the business. And if they're creditors of the business, they are viewed as being a liability. And we know liabilities are bad because they're obligations that will give rise to a future outflow of economic benefit. Just something to think about, guys. Let's look at this question. How is debt marketed to the consumer? Remember, we spoke about perspective being important. Well, this is a really good example that you probably haven't realized in reality, and I hope you do realize it going forward. We know debt can be good and debt can also be bad. Remember, businesses are the ones who are marketing their products. So businesses are going to be marketing debt as credit. So when you go into a store and you're looking at taking out credit, what do they always advertise and market to you? Well, they say, come into our store or into our business and we'll give you a credit card. We'll give you as much credit as you would like. Come and extend your credit limit with us. Those are all phrases that you've probably heard before. But we don't realize as consumers that the credit that we're being offered isn't from the business's point of view. It's actually the opposite, because we're the individual or the consumer that's actually going to be taking that inverted commas credit from the business, which is actually debt. So have you ever thought about this? The credit card that you carry around with you everywhere you go, is it actually credit or is it actually debt? Well, if you think about it, the right answer is actually debt. Why? Because for you, if we're looking at the accounting specifically, you as the consumer have an obligation to pay in the future, okay, which will give rise to an outflow of benefit, and that payment that you're going to be making in the future is going to carry interest, and that payment will be made to the institution that you took out the credit. So credit is good from the business point of view, because for the business, they're going to be getting inflows from the customer that took out the credit. But we don't realize as consumers that it's actually a debt. Okay, a debt card. So when you look at that credit card, remember, for you as a consumer, that credit card that you carry around with you is actually a debt card. So that's why accounting is so important, and it's quite practical as well. Knowing what assets are, knowing what liabilities are, will help you better make decisions that can help your financial situation. So next time, think about perspective. Perspective is key. If I'm going to be taking out a loan, then I will view that as being a liability, because I'm going to have to pay that in the future. On the other hand, if I'm going to be granting credit to someone else, or if I'm going to allow someone else to take out a loan with me, that would be viewed as an asset from my perspective, because I am going to have a resource that will give rise to future economic benefit. So very important is definitions. Remember, you need to know what the definitions are in order to understand and interpret the information. So when we look at someone's set of financial statements, we'll be able to identify what's good and what's bad, so we will make good decisions. Remember, the key for the actual financial statements is decision making. That's the ultimate goal, is to try and make a decision. The accountants create the books, and someone else uses those books to make a decision. It could be internal or external users. These are all topics we covered before in previous videos, and we know that users are all about the decision making. The rules. We've seen this before. There were 6 rules that I've shown you in a previous video. Just to recap, the most important one for this particular topic, which is a liability, is the debit and credit in terms of the pluses and minus. So when looking at financial position, today we spoke a lot about a liability. We spoke about the definition. Now we need to look at the accounting rule again. Remember, when looking at analyzing transactions, we're going to be practicing applying the increases and decreases in terms of the pluses and the minuses. So when looking at a liability, what do we do with the debit and credit? Well, if I'm looking at a liability, the credit will increase a liability account and a debit will decrease the liability account. And that's how we would treat it from an accounting point of view. So when recording an increase to a liability, so if I had to take out a loan, my liabilities will increase, and therefore I would have to credit that particular account, being the liability. We need to look at both assets and liabilities to then determine the financial position. And that's the end of this video. Please subscribe to the channel and please comment below. Tell me about your experience with liabilities. Have you taken out too much debt perhaps? Or maybe you've never thought about debt as actually being credit, or you viewed credit as being very positive, or you hate credit and you view it as being very negative. Some people love credit, some people hate credit. It all depends on you and your perspective. So please leave me your comments below. Like the video by hitting the thumbs up button, and please subscribe. Thank you for watching.